Welcome traders. In this playlist, you'll have access to my lecture notes on the ICT Core Content Mentorship. The Core Content is a comprehensive mentorship on the marketplace, and many of the videos are very long and cover advanced concepts. So in this playlist, I will be summarizing the ICT concepts taught in these videos, breaking it down and giving my opinions in my own words. You can call this Spark Notes or Cliff Notes, but I'm just going to say these are my lecture notes. If you want to watch the original videos, I'll have it linked in the description of each video, but you can help support this channel by giving this video a like and watching till the very end. Watch time is very important for the algorithm, so you can just have this on in the background if you aren't able to focus on it right now. But make sure to take your own notes on anything that resonates with you, and let's get started on this first one, elements to a trade setup. So the two main parts in a trade setup involves the context or framework and reference points. The context is the overarching idea to a trade. You may refer to this as narrative, but it boils down to identifying what market condition we are currently in and anticipating what the next market condition will be. And we'll get more into this later on. Now, as price is moving from one market condition to the next, we use reference points to help us navigate and determine whether the market condition is changing or staying the same. For each of these market conditions, we'll use a specific reference point: order blocks, fair value gaps, liquidity pools, and equilibrium. We'll talk more about these reference points later on, but first, why are we able to anticipate what the market does? Isn't it all just random? So the reason why we're able to anticipate the market is because the market is not random. It is controlled by the interbank price delivery algorithm, also known as IPDA. Essentially, think of this as a computer program or AI with unlimited money and buying power. No amount of buying or selling pressure is going to overcome IPDA. Now, this may have been hard to believe back in 2016 when this mentorship was recorded, but right now it is 2025 and we see how AI is being used in anything and everything. So I don't think this is much of a stretch to believe this now in 2025. But this is good for us because as an algorithm, it's going to have a list of instructions on what to do with price under certain conditions and at certain times of the day. So this means that if you can read price action and identify the algorithmic signatures, then you can predict what happens next with a high degree of probability. Of course, it's never going to be 100% because there is manipulation through manual intervention. Okay, so let's go back and talk about the context or framework, specifically the four market conditions and their respective reference points. And we always start with consolidation. Consolidation is when the market is going sideways. It is still moving up and down, but it stays in a clear trading range and does not want to move significantly higher or lower. What's happening here is that the price is being held in this trading range in order to build up liquidity in the form of stop loss orders above and below the consolidation. Price will eventually draw to these pools of liquidity when the market condition changes. Now, right in the middle of the consolidation is a price level called equilibrium. This is the reference point we'll use during consolidation. When the market condition changes to expansion, price will run away from this equilibrium price level. We'll get into expansion soon, but let's first take a look at an example of consolidation. So consolidation in the charts will look something like this. Using the bodies of the candle in this example, we see a clear trading range between this high and this low. Right in the middle of the consolidation where the arrow is pointing is equilibrium. Notice how price came back to equilibrium before it goes into an expansion market condition and runs away from equilibrium and away from this consolidation. So from consolidation, the only market condition we can change into is expansion. Expansion is when price moves quickly away from a level of equilibrium. Price shows a willingness to be repriced, but we don't want to chase price. We wait for it to return to the reference point that we'll use here, which is an order block at or near equilibrium. Here is an example. We see consolidation here in the blue box with equilibrium in the middle. Price taps equilibrium a couple of times before going into an expansion to the upside. Now, we don't want to chase price here, but we patiently wait for it to return to the order block near equilibrium. The bullish order block is this last down close candle near equilibrium. price did return back here before rallying up even more. Now, this is not 100% guaranteed to happen. Sometimes price will keep going up without returning here. Sometimes price will reverse and move in the other direction. However, in scenarios like this, you see that by patiently waiting, we can potentially be buying low and selling high. So make sure to pay attention to the order block at equilibrium. And if price is moving bearishly to the downside, you want to look for the last up close candle near equilibrium for the bearish order block. So after an expansion, we'll go into either a retracement or a reversal. Let's go ahead and talk about the retracement first. Retracement is when price moves back inside the recently created trading range. The market makers are willing to reprice to levels of inefficiency where buying and selling were not both offered equally. Remember, during expansion, price is moving away from equilibrium quickly, meaning only one side was being offered, either buying or selling, not both. This leaves a fair value gap, which is our reference point for retracement. In this example, you can see an expansion to the downside in this quick, sudden movement down. Price moved very quick and mostly offered selling and not much buying, which leaves gaps in price and created a fair value gap here and here. The market then goes into a retracement in order to balance this large inefficiency and fill in the gaps. Now, there are two opportunities here. We could look for indications to go long, anticipating a retracement to fill in the gaps. Another opportunity is to go short once the gaps are filled, anticipating a continued expansion to the downside. Now, a fair value gap does not have to be completely filled in. This one that's highlighted did get filled in all the way, but this expansion move here has this fair value gap that was never traded to, and this fair value gap was only traded back to about halfway before continuation to the downside. So don't fall into the fallacy of thinking all gaps must be filled. So we saw how a retracement could be followed with a continued expansion. However, we could have a reversal where the retracement completely fills in the gaps and keeps going further. So a reversal is when price moves in the opposite direction of the recent expansion. The reference points you want to focus on here are liquidity pools above old highs and below old lows. Market makers have ran a level of stops with the expansion, so rather than anticipating a retracement and continuation, which could still happen, but you want to keep in mind of a potential reversal and look for any indications of a significant move in the opposite direction. In this example, every X is where stops would be, which are liquidity pools. Notice how many times price will go just above or below these pools of liquidity, reject, and move in the opposite direction. So in this video, we learned that the market is not random and is controlled by an algorithm. And because it's not random, this allows us to analyze the market by using reference points and predicting future market conditions to give us profitable opportunities. There's only 4 market conditions, and the market will switch between these, not randomly, but logically. We always start with consolidation, where price moves around an equilibrium price level. At some point, price will expand, quickly moving away from equilibrium, but remember, don't chase. Wait for price to return to an order block near equilibrium. This is also the retracement market condition, where price pulls back into the range that was recently created. During retracements, we're looking for the price to rebalance inefficiencies like fair value gaps. Just remember that not all gaps need to be filled. Now, should the expansion move take out a large pool of liquidity, we may be heading for a reversal with a significant move in the opposite direction. So we went over a lot, but you don't need to use everything here to be profitable. You just need one element that resonates with you to have consistency. And if you're new and you don't understand what an order block is, what a fair value gap is, don't worry. We will be going over these soon, but for now, just jot these terms down in your notes. After we learn about order blocks and fair value gaps, then come back to these examples and you'll see clear as day where these reference points are. I hope you found this video easy to understand. If you enjoyed it, please leave this video a like and subscribe for more of my lecture notes. And until next time, safe trading.